and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hey, happy Dasara everyone, and welcome to the Capital Mind podcast. Once again, we have a very interesting show for you today, and this is Aditya and me here on the podcast going to talk about some very newsy concepts that are happening right now: taxes, Z, Yes Bank. So firstly, happy Dasara Aditya, and let's get on with this next part of the show.
Happy Dussehra, Deepak, and happy Dussehra to our listeners. So today's podcast is going to be very juicy. We have lots of stuffs going on. But let's start with Yes Bank. So you and Shrish recently wrote an article on Yes Bank and it went viral. Tell us something more which we want to know about Yes Bank, whether our deposits are safe, and do you think the price is going to recover?
Yeah, so it's quite interesting from an article point of view. The article has numbers, the article has reasoning, but let me give you the lowdown. The issue really is, are your deposits safe? And that's come across only because RBI has brought about this extreme action on this PMC bank, on which we had done a podcast where we said, you've suddenly taken a good 11,000 crores of deposits in a bank and told depositors that you can withdraw only 1,000 rupees. They changed it to 10,000. Now recently they've changed it to 25,000. So now this brings into question stocks like Yes Bank, stocks where you've seen problems in the fact that they've had to take on a little bit higher provisions than otherwise would have been required. Their growth has slowed down, and people start wondering, should I take my deposit out of Yes Bank? So my point of this whole thing was that firstly, RBI has been a little irresponsible in doing ad hoc sudden stopping of withdrawals, even though there's a deposit insurance of 1 lakh rupees per account. Honestly, people are scared. So why should people continue to retain deposits with Yes Bank? The answer to this is two things. First of all, the bank's accounts itself don't show us the kind of panic that people seem to have in their heads. The deposits seem relatively safe.
Okay.
And to that extent, if you look at the numbers that they have 58,000 crores in government bonds out of the 2 lakh crore deposits. That's 25% straight away, or 30% really. And then they have loans worth 2,30,000 crores. Now, even if you sold, they have another 10,000 crores of cash with the RBI. They have another 5,000 somewhere else. So there is essentially about 75,000 crores of very, very liquid assets that they have. They have also told us that they're seeing a certain amount of this is a rationalization in their loans. They have a 10,000 crore problem loan already that they've taken, about 12,000 crores of NPAs, and around 29,000 crores of loans where the borrower is less than BB. Even if all the BB loans were to go to zero and their current NPAs were all supposed to go to zero, they would lose roughly 25,000 crores. This would take 8 quarters, because RBI gives them about 8 quarters to write them down. In those 8 quarters, they will generate 12 to 13,000 crores of profits because they have other loans which are good. There is a potential another fundraise that will come up. So at max, I think even if they were to take this extreme step of where all these loans go bad, their capital ratios will still be okay at about 15,000 crores of assets for about 1,70,000 crores of loans, which is not unsustainable. In the sense, it is still a decently strong bank. You should not see the bank having a problem, even if it had to be liquidated tomorrow. That will at least generate enough money to pay back all its depositors. I think that part is clear, that deposits are safe. What is not safe perhaps is bondholders. Long-term bondholders may have to take some kind of hit if there's an extreme event. I don't expect that to happen also, but still, if that happens, it will be only bondholders that anyway will have assumed this risk to come to them. I think that will happen, and Yes Bank depositors are safe. Shareholders, I don't think it's a great time for anybody to buy Yes Bank stock. It's a lottery, but the chances of winning substantial amounts are very low.
I was about to ask that, Deepak. So case with Yes Bank is after every 20-25% fall, people ask kya lagta hai, and after every 20% fall, the stock becomes attractive again.
Every stock actually becomes more attractive when they fall, but it can take a lot of time for a stock to recover. So
Correct.
I don't believe that Yes Bank will recover in a hurry. But it could recover. It could take some time, and then as more information comes, there will be better times to buy the stock. So I'm not so interested in the stock. I am, however, of the opinion that deposits are safe.
Great. Glad to hear that. So we'll move on to another topic. So recently we got to know that the promoters of Z have pledged 90% of their holdings. Previously, what we thought that Z made some strategical errors, their exposure to infra projects and all that. Now I believe the question is of integrity, because they did not disclose this before. So do you believe that now their books can be trusted? Because once you come up with these kind of cockroaches, then there may be more.
Aditya, the problem with investors is that we've seen increasing regulation bring in more transparency in the last few years. This transparency was not there earlier. So earlier also promoters used to pledge their shares. They didn't used to tell us.
Exactly.
Then pledging became a disclosable event. So promoters had to disclose their pledges. So when they didn't want to disclose it, what they did was they did innovative structures. In Yes Bank, the promoters went in and said, we will give you these shares with a non-disposal undertaking, which means I won't sell these shares. I won't sell these shares because if I sell these shares, you quasi hold them as collateral and therefore you should have a right on them. But I won't actually pledge them, because if I did pledge them, I would have to reveal the pledges. So this quasi pledge was one way to kind of get around the rule of having to disclose your pledging. Second thing was where promoters, and even now they've done this, they have taken a bunch of demat accounts. They have put their shares into those demat accounts and give her a power of attorney of that demat account to the NBFC itself. So that means NBFCs have given a company loan, but not actually taken the stock on a pledge, but they have the power of attorney on the underlying demat account, so they can sell those shares whenever they want and take the money. So this is also a quasi-pledge. Because of the wording of the recent SEBI circular and a bunch of restrictions on mutual funds, a lot of these guys have reduced their allocations to such instruments where, pledging is happening or quasi-pledging is happening. But they've also, wherever they continue to exist, they're forcing the promoters to reveal that there is a quasi-pledge or a quasi-encumbrance of the promoter's stock. This actually adds to a layer of information in Z, which suddenly says 2 years ago they gave a loan with some kind of non-disposal undertaking, and therefore the actual pledge underlying the entire promoter holding is 90% and not 60% as we thought. So effectively, Z's entire promoter shareholding is pledged. However, what we don't know, and remember, Z was a stock that was operated by Ketan Parekh. Okay. We don't know if Ketan Parekh acted in collusion with the promoters or with a bunch of FIIs, because if you look at the FII holding of Z, there is 47% of Z held by FIIs, out of which the big guys, that is anybody who owns more than 1% of Z, add up to only 19%. So where is the remaining 30% of Z holding or 29% of Z holding, which is held by FIIs?
Interesting.
It's held by a lot of FIIs who have less than 1% shares, right? So who are these FIIs? Why are there so many of them? And how come they all own these tiny little percentages of Z? Are they connected to the promoter or to Ketan Parekh or to some other such entity? And at some point, we don't know the answer to that. So even if the promoter's actual revealed holding would be, let us say, 20% now, and may fall to 2% if all the pledges are invoked. There may still be some quasi-ownership through the FII route, which can still exist, and that may further have other encumbrances on it, which we don't know anything about. So there is a lot of questions currently still unanswered, a lot of things we don't know. And all of this information will come to us. The governance issue may be real, but I think it is real for all of India that people will only reveal when they are forced to do so by regulation. Until that time, they will not reveal.
Exactly. We recently did a podcast on corporate tax cuts. You asked me to look at the deferred tax assets accumulated by the private and public sector banks, and the numbers are amazing. So I just looked up the major private sector banks, and the numbers are huge. So just the private sector banks, 10 or 11 of them, have deferred tax assets worth 60,000 crores. And when we talk about public sector banks, it's another 70,000 crores. So when they move to the new tax structure, they're going to lose this asset, right? So how is it going to pan out?
So interesting aspect of accounting here is that what the income tax agrees is your profit and what the Companies Act says is your profit can be two different things.
Exactly.
And one of the areas of difference is by the fact that, for instance, you may have a certain set of provisions that you've taken in your books that are disallowed by income tax to be taken as expenses in the current year. Now, let me give you an example. Let's say you have to provide gratuity to your employees, and your gratuity to your employees is, let us say, half a month's salary per year.
Okay.
So let us say my gratuity adds up provisioning today. I'm not actually giving the gratuity, right? So I'm actually creating a provision for it. When I create a provision for it, I will say that, listen, my profit was actually 10,000 crores, but my provision for this gratuity is 2,000 crores. So please note that my profit is actually 8,000
crores.
Which means my profit is lesser because of this provision that I put in. The income tax guy says, boss, this provision was not exercised. It is not real. Your gratuity hasn't been paid out actually. The income tax department says, I don't understand all that stuff. Pay me the tax on 10,000 crores. So you pay 3,500 crores as taxes. And then you say that, listen, I have a 2,000 crore deferred tax asset on which my deferred tax itself I can save about 35% of that, which is about 700 crores.
Okay.
So I have a deferred tax asset of 7,000 crore, of 2,000 crores on which I can tomorrow save tax of around 700 crores, because when this gratuity expense actually comes about, my profit on, according to my Companies Act, will be higher because I will just take away from the provision instead of actually debiting my profit and loss statement. Whereas what the income tax department will say is, this year you can take that as an expense. That's fine because you actually incurred that expense. So effectively, you will have paid tax on a profit that isn't actually your profit,
Okay.
but you will defer it to a later point. Now, there are some points over here where the expenses will be allowed at a later date, so it's perfectly fine. So I might take a provision for a bad loan that is compulsory because RBI requires me to take a provision, and Income Tax Act might actually allow that to be taken as an expense. But I might take a higher provision based on my own assessment of what the losses are. So in which case, Income Tax Department will say, listen, I don't want you to take extra provisions. So those extra provisions I will tax as income. So for the world, you will say my income is lesser. So I will pay a higher tax and record a lower actual tax number paid on my balance sheet.
So basically, I've paid more tax to the government, which becomes my asset.
No, so the extra I will offset back, and I will say, instead of paying 2,000 crores to the government, assume I have paid only 1,500 because this other 500 crores is available to me at a later point, and therefore the deferred tax asset to take it.
Okay.
Now there is a tax cut, and he says you can pay tax at 22%. You say, well, that's perfect. You know what? I'll show you my profit. This is my profit. And you know what? I have a deferred tax asset. No, so I will reduce my profits today because the deferred tax asset can be offloaded onto the balance sheet when the expenses actually happen. The deferred tax asset is now written off because if you take the 22% tax regime, you can't use the deferred tax asset according to one of the laws.
So it's a loss for them.
So it's a loss. So they will have to write down this entire amount. Now this entire amount is 60,000 crores for private sector banks. That much of their profitability will go. Will it all go at one time? Will it go over a period of 10 quarters? Or because RBI might allow them to offset it over 10 quarters? Because whenever you take an asset and say that asset is worthless now, because I'm going to the 22% tax regime, 22% tax regime does not allow me to take the deferred tax asset, I am immediately going to lose that amount. Let's say HDFC Bank has 4,300 crores in deferred tax assets. It's going to write off 4,300 crores. If it has to do that in 1 year, it is going to be a significant portion of its profits. Yeah. All the growth that we are seeing in the company right now will be offset by the fact that you have to take this loss. It's an accounting loss. It's not a real loss. If this is not available, I will have to deplete the asset. When I deplete the asset, I will actually have to write off the loss. So if I lose 60,000 crores as a whole in private banks, the private banks might stand up and say, listen, I'm not going to take this loss. Might as well pay tax at 35%. I have a choice. I can either go to the new regime, and if I go to the new regime, I can't come back to the old regime. So I have to go to the new regime and stay there. Or I can stay with the old regime of paying 35% tax. But I can do this in a subsequent year, next year. Or
First exhaust the deferred tax assets.
Assets. Look at SBI, for instance. It has offset the deferred tax asset that it had, which was in 20,000, 30,000 crore type things, by about 1,000 crores last year, 8,000 crores years before that, and so on. So all of these deferred tax assets have actually been used by SBI in the part of their mergers, when they've got losses to offset, and so on. So they have been able to use that deferred tax asset, whereas HDFC Bank, because it has not had more loss-making quarters and actually taken higher provisions than required all the time, it is in a position of having a deferred tax asset that it hopefully can use in the next few years if they actually see losses on their books. So if HDFC Bank has to go to the 22% tax rate, it will have to write down these 4,000 crore of assets. Now, even if it did it over 4 years, that's 1,000 crores every year.
Yeah, that's a big number.
If HDFC said, listen, I'm not going to lose 10% of my profits every year. So then what happens? All that benefit that we were supposed to have gotten because of lower tax rates suddenly goes to zero. And I'm talking only financials here. I haven't looked at NBFCs. We haven't looked at companies with deferred taxes like ITC or any of the other manufacturing companies, FMCG companies. They will also have deferred taxes. Then a number of companies that are actually benefited will become much lesser. And the deferred tax asset loss may push people to anyway pay tax at 35%, in which case the benefit to the country is not that 1,40,000 crores that was mentioned.
I'm surprised that no one is talking about it.
Now I think people have started to talk about it because only recently did the clarification come from the income tax department about deferred tax and about MAT. So both of which are not allowed. And MAT is another big problem because MAT is a tax you're forcing me to pay even though I don't have to pay it. Saying that, listen, if you pay it today, you can use it tomorrow when you actually have to pay tax, and you can say that you paid this MAT tax, so therefore you can carry it forward and pay that tax. Similarly, a deferred tax credit is the same thing. You pay extra tax today, but you can use it tomorrow to offset tax that was actually payable on that time, and you can say that, listen, I already paid it in the past, so it's okay. But to write that down to zero, both from a MAT credit perspective and from a deferred tax asset perspective, will hurt a large number of the big companies that are supposed to benefit. And that might just negate the impact of this tax cut, which basically means there is no stimulus as much as we think it is.
Exactly. So that was the last question, Deepak, and thanks a lot. Thanks to our listeners. Just wanted to tell you, Deepak, in a month, our viewership doubled actually. We are sitting at around 21,000 unique downloads. Just a month back, we were sitting at 10,000. So looking forward to 100,000.
This is brilliant. Thanks so much, guys. It's been fantastic to be able to, communicate using this medium rather than just the text. So we'll have more. We'll have a lot more on the podcast area for you all. We've done macro, we've done economy, we've done interest rates, we've done stock specific and policy specific stuff, but there's a lot more to come. Visit capitalmind.in. Do consider joining the Capital Mind Premium, where we have discussions of this sort and a lot more on a regular basis. Please rate us on Apple Podcasts, on any other platform that you're using us, and give us your feedback on what you think can be improved and what you think you really like. So we'll keep doing that stuff for you. Happy Dasara to you and your families.
Thank you, Deepak. Thanks a lot.